Good morning and welcome to this special edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for distinguishing between cyclical and secular bear markets. Before we get started, I want to take you over to earningsbeats.com. For those of you who are not aware, we do a annual MarketVision event. This is our fourth one. This is MarketVision 2023. If you go over to earningsbeats.com, you'll see an area here toward the top of our homepage where you can click to get more information on the event. I'm inviting everyone to register. All it takes is a name and email address. This is a free event, so no credit card required. You can unsubscribe at any time. Also, if you can't make the event live, we'll make sure you get a copy of the recording. So even if you can't make it, you have something else planned, or you just don't want to commit that much time, still sign up with your name, email address. We'll make sure we get a copy of the recording to you. It'll be time-stamped, so you can go in and listen to whatever might interest you. But if you go over to the page, in addition to registering, if you scroll down, you can check out some of the things that might be of interest to you. We put together a little short video talking about some of the predictions that I made personally at the first three MarketVision events. So you can kind of get an idea of the types of direct predictions that you'll get at these events or at this event. Also, you can take a look down below to get some more information on the speakers. So there I am. You've got Grayson Rose, you've got David Keller and Joyce DeKempenaar, all of StockCharts.com, who have agreed to come and join me. Just a wealth of knowledge and talent and experience. And I would certainly encourage you to make sure you get over and sign up to be part of this special event. Again, it's on Saturday, January 7th. It'll start at 9 a.m. Eastern. Don't have a firm time when it ends. It'll probably be around 2 o'clock, maybe 3 o'clock in the afternoon. But again, we will make sure you get a copy of the recording. We'd love to have you, so please make sure you sign up. Okay, so for today, this special event, what I wanted to do was just go through and talk about bear markets. 2022 has been one of the more challenging years because we topped almost immediately right at the beginning of the year, and it's been this constant move lower throughout the year. Most of the damage was inflicted in the first 6 months of the year, but we still are trying to navigate, trying to make sure we've got a bottom printed, and yet we can't be sure. So sometimes the best way to look at and anticipate what might happen in the market is to look in the past to see what's happened before. So I want to start off first with a big overall chart. If you've been to any of the events that I like to do, you know I like this long-term, big picture, 100-year chart of the S&P 500. This is a monthly chart, and I think it's pretty cool because it's encompassing everything that's happened in the stock market for the last 100 years. That's a long time. I don't think any of us probably were around since the beginning of this chart. So everything that's happened in the stock market in your lifetime is right here. The big difference between secular bear markets and cyclical bear markets it's simply the duration. So when you get into a secular bear market, you have to think long term. For instance, when we topped back in 1929, we honestly didn't break out. Well, we had a couple of reaction highs in the 30s and then again in the 40s. And I like to kind of paint those as kind of the key tops because after the big collapse that we had into the early 1930s, that was as high as we got. That was as good as it got. So finally clearing that level in the 1950s, in my mind, began the first, on this chart anyway, the first secular bull market that took place during the 1950s and 1960s. And you can see that 20-year period we went straight up. That led us into a period where stocks were out of favor for quite a while. 1970s, you can see sideways action, just simply couldn't go anywhere. And as a result, from 1969 through 1981, we never could negotiate that high that we eventually saw at the end of 1972. We did clear the excuse me, the 1968, 1969 high in 1972. But then it was really just, pardon me, but it was really just sideways action. We did put in a couple of lows, the lowest of which went in 1974. And then finally in 1980, we break out. We start the next 20-year secular bull market. Then from 2000 to 2012, rinse and repeat. Looks very similar to what we saw in these other red shaded areas where we just can't seem to go anywhere for roughly a dozen years. 2000 to 2012, we were contained by the highs of 2000 and 2007. Look at the lows that we saw, very, very similar to what we had seen back in the 1970s. Put in a low, went back up to a high, came back down to a slightly lower low to mark a major bottom, to a low, to a equal high, and then to a lower low to mark a final bottom. Then we began this up move, which in 2013 culminated in that breakout above the 2000 and 2007 highs, and that has triggered the latest secular bull market. So right now we are in a long-term secular bull market until proven otherwise. And you can see these prior to went about 20 years. Right now we're into about the 10th year of the current secular bull market. Does that mean we got another 10 years? We don't know. If history's any guide, then yes, that's what I would be looking for. But right now, I would say we are in a secular bull market. Now, while we've got all these years up, I want to just talk about a couple of things that are common during secular bull markets and how you can begin to see maybe a shift into a secular bear market. During secular bull markets, a couple things. Number one, check out the monthly PPO. The monthly PPO, this is our momentum indicator, and the monthly PPO can take off. It can get up to 10, maybe even 15 to the upside. And all this is the difference on a percentage basis between the 12-month and the 26-month EMA. So you've got to keep going up at a pretty steady pace to keep this monthly PPO above zero. But during the 1950s and 1960s, and also during the 1980s and 1990s, and since 2013, you can see that the monthly PPO, with maybe very, very slight and minor exceptions, remains consistently above the zero line. In other words, the selling never lasts long enough for the monthly PPO to go negative. When we go through bear markets, they're considered cyclical bear markets or short-term bear markets because they don't last as long and they don't go down as far. Notice in the 1950s and 1960s, we had 4 cyclical bear markets, but it was all within the long-term secular bull market. Look at the depth of these bear markets in the 1970s. Look at the depths of the bear markets, these 2 bear markets in the 2000s. They're so strong and they last so long that look at what happens to your monthly PPO. Decidedly negative, decidedly negative, decidedly negative, decidedly negative. Look at where we are right now in latter part of 2022, still above the zero line. So one of the things that's necessary to trigger a secular bear market is we need to see the selling last long enough and deep enough to trigger a centerline crossover on the PPO. We're not there yet, but you can see the PPO is going down to the downside, very similar to what we saw back in the late 1990s, early 2000s, maybe to a lesser degree what we saw back in the late 1960s before we finally moved over into the negative territory. But this is all really important information that you need to be aware of. The other thing that you want to watch for is the monthly RSI. During secular bull markets, the monthly RSI generally holds the level of 40. Again, the selling doesn't last long enough to get us through 40. When we go through and we have these cyclical bear markets like we see in here. There's 1987, 1991. Here's early 1980s, 1998. All of these, the RSI, monthly RSI goes down below 50. Well, this one didn't in 98, but the others went below 50, but we never went below 40. Back in the 1950s and 60s, all of these resulted in the RSI getting very close to 40. And we had just slight breaks twice in 62 and in 66. But look at what happens to the RSI, monthly RSI in secular bear markets. Below 30, well below 30 here. Down to 30 on this first one right here. Below 30 and below 30. Again, the selling lasts so long that it takes this RSI indicator down to levels we generally will not see during a secular bull market. So those are just some things, to keep in mind, excuse me, as you approach 2023, and whether or not this is secular, long-term, or cyclical, short-term. Now, let's quickly go through the decades. I just want to walk you through, and let's annotate some of this. This is back in the 1950s. So we were in a secular bull market. You can see the market doing really well, but that doesn't mean we don't have periods when we struggle. And so if we take a look at the percentage change, and I'll just drag a couple of these. Let's just take a look at this first one right here. We went down about 15%. So this doesn't qualify as a cyclical bear market because it was established, and I don't even know how it was established, but the threshold for a bear market is 20%. So this was a correction that lasted 9 months, but it was not a cyclical bear market because it never achieved that 20% drop. Later in the 1950s, however, we went down here and dropped about 22% from the mid-1956, mid-1956 till the fourth quarter of 1957. So that lasted about 15 months or so before breaking back up to the upside and going to new highs. All right, let's take a look at the 1960s. Okay. In the 1960s, you can see we're continuing to go up. Still in that secular bull market, long-term, 50s and 60s. Go back to this other chart right here, 50s and 60s, okay? So we're getting close to the end. And you can see in the 1960s, we had some issues. This was a much more difficult decade than the 1950s because we did see some fairly significant drops throughout this decade. Right here, almost 30%. This was back in 1962, and it occurred over about a 7-month period. Went up, we went back down, not quite to a double bottom, and then right back up again. Then we had some of these others, we had some smaller drops, like right here. That was a little bit more than 10%, so that was a correction. But look at this one here. In 1966, 24% drop. So another cyclical bear market. Not every bear market is like 2007 to 2009. A lot of folks are looking at this one and saying, this is 2007 to 2009. I think that's a premature call. Maybe it turns out to be the same or similar, but right now I think it's premature. And you have to understand, here in this secular bull market, we had a 7-month period here where we lost 30%. We had a 9-month period here where we lost 24%. We had some other periods in here where we had corrections. Here we lost 12% in 67 into 68. And then at the very end, you can see this drop. We went down roughly, actually, I think we were just over 20% right there. Actually, maybe it was right on 20%. But this drop into 69 from December through maybe August, so 7-8 months, 20%. All of this occurred in the 1960s as we were winding down a 20-year secular bull market. So let's go on now and let's look at the 1970s. And this is all about perspective, trying to keep perspective. So now we're into a secular bear market. Long term, where we just couldn't notice the difference between the last 2 decades I've shown you, the 50s and the 60s. When you go from the left side of the screen to the right side of the screen, it's just up throughout the entire period. In the 70s, we had a big drop into the early 70s. Then we had a nice, this is a cyclical bull market, short term, only lasts 2 or 3 years. And then we start the next bear market. But let's annotate and let's take a look at these declines. We already started to look at that the late 60s. So I'm going to start this one with right here. So this is the beginning of a long-term secular bear market. Now notice a couple of the differences. First, we dropped 50%. Cyclical bear markets don't go down 50%. Cyclical bear markets normally are in the 20 to 30 range. We've had some go down about 35%. Think 1987 crash, think the 2020 pandemic, where in a very short period of time, the market panics and we saw 35%, both of those, but they were over very quickly in about a month. Here, this goes on for almost 2 years, a year and 9 months, 21 months, and drops 50%. Now, what I could have shown you is that in the first year of this, we dropped 18% roughly, maybe 18.5%, had a little rally, and it wasn't until we were almost a year in before it actually qualified for a bear market at all, because you got to go down 20%. So we didn't get down 20% until right about here. And then we went down 26, 27%. And then we rallied back up. Now, if it were like other bear markets that we had seen in the 50s and 60s, that would have been it. But no, instead, in 1974, we absolutely got crushed over the next 6 months. Very, very, very painful. Notice we had a double bottom in here. That when we went up, we put in a head and shoulder top. And then once we dropped, we had a lot further to go. And that 1974 collapse right there, if we go back and look at the 100-year chart, 1974, this is where it began, right in here. At the same time, that PPO went deeply in the red, below zero. At the same time, the RSI, the monthly RSI, went down. This is what happens at the end of a secular bear market drop. Okay, so now we don't really consider these over here bear markets. And you might say, well, why not? Because here, if you calculate, we went down roughly 20%. However, we weren't coming off of a high. So here we went down to a low, we rallied, got back up to this level, but we never even put in a new high. So when I look at bear market calculations, I want to see that there was a new all-time high established before that bear market began. This to me is just part of the consolidation on the subsequent rally off of this earlier bear market. And again, if we take a look, keep in mind, this bear market went down 50% in a year and 9 months before we rallied back up. All right, now let's move on. How about the 1980s? Now, what does this look like? This kind of looks like the 1960s, right? 1950s. Nice, beautiful move from the left side of the screen to the right side of the screen. You want to be in the market during these secular bull market runs, and you want to be careful when you have these cyclical bear markets. So let's again annotate. And let's start from this top over to this bottom. 29%. This went about a year and, what was it, a year and about a year and 9 months. So that was similar to what we saw in the 70s, but we only went down 29%. It wasn't 50%. A secular bear market's both duration and degree of loss. Both. That's what distinguishes a secular bear from a cyclical bear. All right, let's move on. Over here, was this a cyclical bear? No, we lost 15%. That was just a correction. How about 1987? And there you go, 36% in a month. Yes, that is a cyclical bear market within a secular bull. That was the 1980s. Let's move on to the 1990s. Again, it is all about perspective. All of these bear markets, I don't care if they're cyclical or secular, they're all painful. They all seem like they're the worst bear market ever. We had a 3-month cyclical bear market in 2018, I'll get to in just a minute. That felt horrible. It lasted 90 days, went down 20%, and that was it. All right, 1990s, let's annotate. So first things first, beginning of the decade, we had the Gulf War. And the Gulf War went down. We went down for about, 6 months or so, 20%. And then right back up again. We make new highs. We just keep going up, up, up. The only other, cyclical bear market we had was back in 1998, 23%, and that was in about 3 months. So sometimes these cyclical bear markets can be very rapid and hit that 20% threshold, and then they're done. And then we're right back up again. And so you can see 1990s had 2 brief cyclical bear markets within the long-term secular bull market. Again, this is the 1990s. If we go back to that chart, here's the 80s and the 90s. Last 2 decades I just showed you. Now we're going to go into the 2000s. So let's take a look. And once again, this kind of looks like the 70s, where we're not going up from left to right all the way across. Much more choppy. Here we had 2 very significant bear markets in a 10-year period. And so let's take a look and see. I believe the high was over in here somewhere. Can't see because of the legend there. But that was probably close because I do think we went down right around 50%. So it was probably something like that. Anyway, 50%. How long did it take us? Well, from 2000, middle of 2000 to the latter part of 2002. Well, actually, this was, this would have been 2000. It's 2001. This is 2000. So it would have been the middle of 2000 to fourth quarter of 2002. So we're talking about 2 years and 3 months. The duration, the degree, 50%. Now let's look at 2007 high to 2009, 57, almost 58%. Over how long? Well, 2007, October to 2009, first quarter there, roughly a year and a half. Roughly a year and a half. Again, length of time much longer, and look at the degree of loss. Now, the other thing I'd want you to look at too, though, is where were we after the first 9 months or so? There's 30%, 29%, big move up. And then we set a new low, rallied back, another new low, continued setting these new lows. Now, if we go over here, we had this drop right here, which was about 24%. So that could have been a cyclical bear market, but it wasn't. It accelerated at the end of 2008. Over here, we accelerated in 2001, 2002. So if we go back to our chart, 2001, 2002, right in here, when we accelerated to the downside, there goes your monthly PPO to the past the zero line. Here goes your monthly RSI down below 30. In 2008, same thing. Once we hit 2008, we had that big move down at the end of the year. That's when your PPO fell apart. That's when the RSI went all the way down into the teens. Monthly RSI hitting the teens. We'd only seen that twice in the last 100 years. Those are indications of secular bear. So where are we right now as we move into the 2010s? This is the point. This is where we are today. 2010s, we appear to be in a secular bull market. If we go over here now and we look at the decade, just as we've been looking at all these others, 2010 to 2019. First thing I want you to look at, actually, let's just do it all the way up to 2022. Actually, we can just do today. There we go. So here's the last 12 years. What does this look like? Does this look like the 1970s and the 2000s where we go sideways? Or does this look like the 1950s, the 1960s, the 1980s, and the 1990s where we go up from left to right? I'm going to go with going up from left to right, that we are in a long-term secular bull market. Now, you might look at this and say, well, this looks like maybe 1969, right at the end of that secular bull market. And listen, maybe it is. The only thing I'm saying is don't jump the gun. Let's talk a little bit about the annotations. So what have we had so far in the last 12 years? Well, 2011, we saw this 21% move down. But we had not yet broken out to new highs. I don't call it a bear market. Remember, we got to get to an all-time high. That didn't occur until 2013. So this one I'm going to delete. Really doesn't add up as a cyclical bear market to me. Next up, though, how about the high in 2015 to the low in 2016? Well, close, but it only went down about 15%. The duration was a little less than a year, so it was maybe 9 months, but it was a correction. It was 15% correction. So let's keep moving on. How about the fourth quarter of 2018? Well, now we're talking, there's a 20% drop. But 3 months later, 4 months later, we were right back at all-time highs and didn't have another big drop until the pandemic in 2020. And there you can see the big drop. And then the rest is history. And now here's where we are right now. Down about 27%. Is it cyclical or is it secular? Let me just tell you this. We're going to have our MarketVision 2023 event on January 7th, Saturday, January 7th. Again, please register now. I'm going to be talking about this. I'll go into a little bit more detail about these bear markets in the past and how this one sets up relative to those. Is it cyclical or is it secular? Join us on Saturday, January 7th. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.